Frances Donald is chief economist at Manulife Investment Management. Frances, great to have you with us. And I did want to get your read on, kind of putting in the mix what we heard last week from the Feds on the fiscal update with what Tiff Macklem may have to say tomorrow. How did those two things fit together in your view?
Well, that's a great question. Now, typically what central banks do and what federal governments do, they're supposed to be entirely independent of each other. But COVID-19, of course, a new world on a lot of different elements of economics. And this is one of them. When you have this extraordinary level of government debt, which we see not just in Canada, but globally, it necessitates very, very low interest rates. Remember, it isn't the amount of debt that we care about for the economy, but the cost of carrying that debt. So there is going to be this intrinsic, implicit motivation for central banks to keep interest rates very, very low when you have this amount of government debt, and of course to aid Canadians. But the second part of this story, also very important, is that we know the federal government is going to be issuing more long bonds, some of those 30-year tenures, and there's going to be motivation. In fact, we've already seen it from central banks and the Bank of Canada to buy more of those long tenured bonds to make sure that interest rates don't rise there as well. So this line between central banks and federal government, not just in Canada, but globally, getting a little bit more blurry here.
And so I want to actually bring in a chart that you've shown us, which is just the expansion of the central bank's balance sheet. And we've seen this in other countries. This puts into context, I think, Frances, what new territory this is for us. We had not done this in this way before. So this will be new for, I think, our citizens to understand this link you're making between the fiscal and the monetary here, those two different policy ideas. How do you think this shapes us going forward?
This is an example of a chart that I say is now broken for me. All of those y-axis scales becoming very distorted by COVID-19. One of the other things that's very different here, to your point, is that for the past 10 years, we haven't really cared a lot about government policy and government spending. It hasn't dramatically moved the macro story. But we're now in an environment where it's government spending that's going to be the main driver of the recovery and not central banks. What Tiff Macklem can do is make sure he keeps this boat steady. Don't rock the waters. He needs to keep interest rates very low. He needs to communicate to markets, we'll do more if necessary, and he needs to make sure he's buying those long bonds in that balance sheet expansion. That's his job, is keep things very calm. The central banks are going to be those that limit the downside risks, make sure there's no credit crisis, but the upside risks, whether we come out of this faster and stronger, that's federal government once again. So the tables have definitely turned over what we care about most from a policy perspective.
Of course, when you see this kind of mounting deficit and therefore federal debt, and that'll stretch on into the future, what do you think the central bank thinks about that? Other than obviously it's to everybody's benefit for some period of time to keep rates as low as possible, since it keeps our rates down as well. Ultimately, though, does it change their thinking about inflation, about deflationary fears? Does it actually distort what the central bank will think it should do because we're carrying this massive new debt?
Central banks want nothing more than for governments to spend quickly and large at the beginning of the crisis. Fill the hole that was the recession created by COVID-19, spend more upfront and less over time. Right now, central banks are not worried about inflation. In fact, they haven't really had to be worried about inflation for over 10 years. They're dramatically concerned about deflationary pressures. And the more the government spends, the less central banks have to worry about that. Now, in this case, if central banks were facing deflation, they can't just cut rates. They're at the zero lower bound. They have to go do things they really don't want to do. Yield curve control, maybe have to talk about negative interest rates, which both the Bank of Canada and the Federal Reserve are very anxious about. So you're going to continue to hear a lot of heads of central banks, including Tiff Macklem and Chair Powell in the United States, advocate for more spending up front. And of course, bond markets are rewarding this. Bond markets are not penalizing countries that are paying for the pandemic up front.
So meanwhile, of course, we want the spending to have some kind of results. We want that early fiscal boost to actually turn into meaningful recovery. Give me your outlook on how we're doing based on sort of the rebound we've seen so far in jobs. It's early, obviously, in the reopening to say for sure, but what's your outlook on how we're doing on the recovery phase?
Well, compared to the rest of the world, we're doing, somewhat worse than Europe or Germany, but certainly a lot better than the United States. The real test for policy is going to come when we have dramatically reduced, even more than we have now, that COVID-19 risk. And the urge is going to be to pull back on that stimulus and spending. But the biggest mistake that we could see from any policymaker is prematurely pulling back on that stimulus. We need those unemployment levels to decline very dramatically from their current levels. We need those to be lower single digit, not higher single digit. So I wouldn't be surprised if we start hearing central banks talk about conditions-based guidance, that they will start changing the way that they're doing mixes of policy when they see unemployment rates fall to a certain number. Before we see unemployment rates fall, we have to maintain this level of stimulus, or else we risk derailing the recovery.
I want to talk about the scenarios that you've laid out, and specifically the third phase of recovery, which is what I think you're calling an L-shaped recovery, which suggests that capacity will be restrained for a long time, a new normal in growth, which will be lower. In other words, the bottom part of the L stretches on. How long do you see that going on?
I certainly think we need to think about the phases here. Phase one being that rapid rebound, probably at the end of that. Phase two being a stall out that occurs beginning about August, September, and extends until we get a vaccine. That vaccine is so important because the vaccine is when we came back to full capacity. Businesses taking in as many people as they want. Hairdressers bringing in as many clients. Restaurants having their tables full. That's what we need to get back to what we think of as the old normal. But we know, of course, that in this new normal, even after the vaccine, we're still going to be in extraordinarily low interest rates, very high government levels of debt, and deglobalization. So no matter what your time frame is from now until the next 5-10 years, those are going to be the key macro themes that dominate the environment, regardless of when the vaccine lands. And that's what I want my clients to continue to focus on, is what that 5 to 10 year trend looks like.
All right, Frances Donald, great to have you with us. Appreciate it.